Welcome back. In our previous unit, we examined how the tax code treats our earnings from our salary, our fringe benefits received from our employers, as well as savings for retirement that are promoted by our employers. In this unit, we're moving on to how the tax code promotes investment and personal financial planning decisions. In this section of the video, we're going to examine which investment earnings are reported as ordinary income. In Unit 14, we looked at the individual tax return and the formula for computing taxable income. Income from all sources, adjustments to income, standard deduction or itemized deduction, and finally, the qualified business deduction. In this unit, we're going to focus on the other sources of income besides salary: interest and dividends, distributions from investments, as well as capital gains and capital losses. The dividends and interest that we're going to be talking about in this section of Chapter 16 are generated by financial assets, which are broadly defined as a legal claim on a company's productive assets. A security is a direct investment through stock, through savings accounts and certificates of deposit, and through notes, bonds, and other debt instruments. These generate periodic interest in the case of bonds, savings accounts, and notes, or periodic dividends in the case of stocks. These are purchased in a single company, and the stocks themselves or the bonds themselves don't have any intrinsic value. The value is generated when the stock price increases or when the company repays you. Mutual funds represent a broad spectrum of securities purchased from multiple companies. They can include both stocks and bonds and other notes. These are handled by investment firms, and they're sold by shares to the public. Mutual funds generate dividends. A separate class of income from financial assets comes from their resale. We'll cover that in the second part of Chapter 16. Earnings from financial assets are reported on Schedule B of the 1040. Part 2 lists the ordinary dividends received from all sources. These are taxed at a preferential rate, which is less than almost everybody's marginal rate, to encourage people to not only invest in these assets, but to cash them in periodically, generating the taxable transaction. The interest from such investments is also reported on Schedule B of the 1040. These are taxed as ordinary income at the same marginal rate as the rest of your income. Certain interest income is excluded. This includes the interest received from municipal bonds, from Treasury note obligations, from Series EE bonds. This amount is deducted before arriving at a total amount of interest. So let's stop and check your comprehension of taxation of dividends and interest by looking at the taxation of Rachel's earnings from her corporate stocks at Bloomie's. Scenario number 1, if the entire $22,030 was an ordinary dividend. Ordinary interest and ordinary dividends are taxed at the ordinary rate, which in this case is 37%. So, 37% of the dividends of $22,030 is equal to $8,151 that Rachel owes to the IRS because of her dividend gains. Scenario 2. $17,540 was an ordinary dividend, and the remaining $44.90 was a capital gain distribution. Again, the $17,000 $540 is taxed at the ordinary marginal income rate of 37%, while the $44.90 capital gains is taxed at a preferential rate of 20%. This means that Rachel would pay taxes of $73.88 on the ordinary dividends and $898 on the capital gains. In the third scenario, $69.20 was an ordinary dividend, $10,620 was a qualified dividend distribution, and the remaining was a capital gain distribution. In this case, the qualified dividend distribution is considered a capital gain, and the textbook discusses what goes into an ordinary dividend versus a qualified dividend. So therefore, the $69.20 is taxed at the 37% bracket rate. And the remainder is taxed at the capital gains rate. This yields tax liabilities of $25.60 plus $3,022. For a total tax liability of $5,582. And as you can see from each of these examples, the total tax liability decreases as these capital gains percentages increase. So that's why it would be in an investor's best interest to classify a gain as capital and not as ordinary. But we'll get more into that in part 2 of chapter 16. Another type of investment gain is a life insurance policy and an annuity contract. A life insurance policy is a legal contract between a purchaser and a commercial insurance company, wherein the owner pays premiums in exchange for a commitment to pay a specific sum or death benefit upon the death of the policyholder. These also have an investment dimension to them. If the life insurance policy is surrendered prior to the policyholder's death, you can actually collect a gain on it. The value of the premium is tax exempt. Life insurance benefits paid upon death or upon near death are not taxable. An annuity contract, likewise, is the purchase of a contract for fixed annual income for a future period of time. The only portion of that investment that you're taxed on is the excess above the initial premiums. Upon the death of the holder, any unabsorbed portion of the initial premium can be deducted on the itemized schedule. So let's take a look about what that would mean, what that looks like. If Ross owned a life insurance policy that will pay $750,000 to his son Ben, Ross paid $69,200 in premiums on the policy, and the policy has a current cash surrender value of $82,500. In scenario 1, Ross passes away and Ben receives the $750,000 benefit. What income does Ben recognize under the tax code? Ben recognizes nothing. Ben is the recipient of the life insurance policy, and he uses these proceeds to cover Ross's funeral death expenses and to cover his long-term needs. He recognizes zero income. Scenario 2, if Ross liquidates the policy for the full surrender value, how much income does Ross recognize? The policy has a surrender value of $82,500, and he paid $69,200 on the premium. So therefore, Ross reports the difference as income, or income of $13,300. In the third scenario, Ross becomes terminally ill and receives an accelerated death benefit of $600,000, or 80% of the life insurance policy. How much income would Ross recognize? Again, the answer is 0, because Ross is terminally ill. He can accelerate the benefits, which means cash in on his life insurance policy to cover his medical expenses and plan for his funeral expenses before he actually dies. This is the same benefit that Ben would receive, only slightly diminished, if Ross had actually kicked the bucket. Under federal tax law, gains and losses are not taxed until an external transaction necessitates it. That is, until a gain or loss is realized through sale or transfer, it's not taxable. We calculate this using the following formula. The realized amount of the sale is cash plus the fair market value of property received. This can also include the assumption of debts. Selling minus selling expenses. We subtract from that the basis in the property, which is the value of the property to the holder, which gives you your net gain or loss. The taxable basis of a financial security is driven by the type of security that was acquired. For example, stocks values are increased based on dividend redistributions and non-taxable reductions in principal. Mutual funds are computed on an average cost basis. If the basis cannot be specifically determined based on the value of securities in one's portfolio, the value is then computed on the first in, first out methodology for each security in the investor's portfolio. That said, the exchange of certain same-class stocks does not create a taxable event. The new basis in the stock then becomes the basis of the surrendered security. And let's take a look at what that specifically means. So if Rachel owns 2,000 shares of Bloomingdale's non-voting common stock with a $225,000 basis, what would be her gain or loss under each of the following assumptions? First, if Rachel exchanged the stock for 1,300 shares of Bloomingdale's voting common stock worth $387,000. In this case, Rachel wouldn't recognize a gain or a loss at all because she's trading one type of common stock for a second type of common stock. Accordingly, she recognizes no gain, and her new basis for the exchange is the basis of the shares that were exchanged, or $225,000. Scenario 2. Rachel exchanged the stock for Bloomingdale's long-term bonds valued at $317,500. In this case, Rachel is exchanging the bonds, or the stocks, for new bonds. This is a different type of security, as well as a different class of security, so she would have to recognize a gain. Her new basis in the securities is $317,500, and she's trading away stocks worth $225,000. So her gain is hence. So for this third scenario, Rachel would recognize a gain of $92,500, which would be taxed at her capital gains rate. Finally, if Rachel exchanged the stock for 900 shares of Macy's stock worth $280,000, but she made this exchange because of a corporate merger, what would be her gain or loss under this assumption? The answer is 0. A corporate merger is the other exclusion to the trade or exchange rule. because this was an event that Rachel didn't have control over. The basis of her stock for tax purposes is $225,000, but she does not have to recognize a gain because the transaction arose because of a corporate merger. In this unit, we looked at the treatment of ordinary dividends and income, as well as the treatment of gains from sales of investments or transfers. In part 2 of this chapter, we'll look at the treatment of capital gains and losses. Until then, cheerio.